Hi, I'm Warren Berger. I'm the owner of Luminary Financial Advisors. And today I want to talk to you about the question that I'm asked most frequently by my clients. And that's, when can I retire? Super simple question with a couple of complexities when it comes to the answer. So we're just going to go through some of the things that I think that you should be thinking about as you approach retirement. So the first thing that I have to do is just let you know that this is not considered to be investment, legal, or tax advice. Just really take this and use it to move forward, but run it by your accountant, your attorney, or your financial advisor to make sure it's right for your specific situation. If you're gonna use any of the things we talk about here. So how do we think about retirement? I like to break it down into three sort of main facets when you're considering when you can retire. So number one is longevity. How long are you going to live? We have to have a sense for how long we have to plan out the amount of money that you have available to you. Super difficult question. We're going to get into that in a second. Also, what are your expenses? Your anticipated expenses in retirement, and fortunately, it's kind of easy to get a gauge on. Number one, you kind of know what you spend your money on in general, but there's also some pretty main things that most people spend on. And so we'll get into what that kind of looks like as well. And then also, what are your income sources going to be? So, we're going to look at sort of reliable income streams and then things that are kind of move with the markets and things like that. So, first thing I want to talk about, and it's probably the most difficult thing to plan for, and maybe the most important, is longevity, or how long you're going to live. And we refer to that as longevity risk, and that's the risk that you're actually going to outlive the amount of money that you have available to you. And I think it's the biggest fear that most people have when they enter into retirement, because you're not working anymore, and your ability to get back into the workforce is going to be limited, if not there, and certainly not desired. And so you have this finite amount of resources available to you, and you have to make sure it lasts. So how do we think about that? I think the first thing we have to look at is, what is your family history? Have there been health conditions that are sort of genetic that you may be looking at as well? Did your family live to a ripe old age, and can you expect to do so like they did? Also, do you have specific health factors that have been entering into your life that could end up affecting, how long that you're going to be around? And so it's a tough conversation to have. It's a tough thing to look at, but we have to get a sense of that. Did the people in your family live until they were 75, 80 years old, or did you have people that were living into their late 90s to a ripe old age? They're just things that we have to consider, and then have the flexibility with your plan as you move along to adjust. So, if your initial plan was going to be, planning out until 85 years old, and now you're at 75 years old, well, now we're probably planning for 90 or 95. And so we're going to adjust that plan as it goes. So there's a really good chart here that comes from Putnam that basically just lays out, if you see on the left-hand side, at age 65, obviously you're at age 65, so you have a 100% chance of living, and then just, where it goes down the line. And you'll notice that there's a real drop off, 68% to 49%, right around that 80 to 85 level. And that's kind of 83 or so is where the average lifespan is for somebody that's 65. But you can see that there's a statistical significant number of people that are living to 85, 90 years old. So that's something that you're going to want to consider as you move forward. So let's move on to expenses. So what are your expenses going to be when you get into retirement? And so there are some things that are pretty consistent with that. And these are the statistically the top 5 expenses that you can expect in retirement, and they're not surprising, right? It's the things that we all deal with. But I want to talk about each one just a little bit, just to get your head around how these things might change in retirement. Because, we've been so programmed throughout our time as we've been accumulating money that we're saving. We are saving for retirement. We're saving for kids' college. We're also trying to live the life that we want to live. But now, as you get into retirement, a lot of those things are behind you. And you're just really getting into the things that are most important to you. And so you have to kind of get a sense of what that might look like. So let's get into sort of housing. How do we look at housing? Pretty simply, do you think you're going to stay in the same house or apartment that you're in throughout your retirement? If so, you probably have a really good sense of what the costs are involved in that, and that's great. And so you can start from there. But for some people, they look as they get into retirement to sort of downsize, right? You've had the big house with the kids, they're out of the house, you're making changes. Downsizing not only the house or sometimes where they plan on living to an environment or a state that's a little bit cheaper than where they're living now. That's going to provide for more money to be entered into your retirement plan. So that's a factor. Some people get into retirement and they say, hey, I'm going to downsize, but I also want to get a vacation home. So we have to weigh the costs of that and how it's going to affect. So, just getting a handle on what those expenses are going to look like. And if you've had these bucket lists and now it's the time that you're going to put them into play, let's get a real handle on what those are going to cost. So then transport is the next one. And that's really just your car, your insurance, things like that. But, how often do you get a new car? Are you leasing a car? Are you the type of person that likes to get a car every 5 years, or are you somebody that sort of runs your car into the ground like I do, and you'll keep it for 10 years and then get on to the next one? But you want to end up budgeting for those times where you're going to need extra cash to sort of either purchase a car, lease a car, or whatever it is that you're going to use to transport. Maybe you're going to live someplace where it's mostly walking and you go from 2 cars to 1 car. Just things to start thinking about as you get into retirement. Healthcare, this is a big one. So are you retiring before age 65? Right, 65 is the age at which you get Medicare. And so, if you're someone that's looking at retiring at 60 or 62, you have to figure out what healthcare is going to look like. Now, if you're leaving an employer, you might have access to COBRA, and maybe that covers a portion of the time that you have to get your health insurance. Otherwise, you're probably going to go to the Affordable Care Marketplace, and which is probably the most efficient way that you can get your health care. But there's things that you have to consider with that as well. So there's tax considerations. There's certain tax cliffs that happen if you have a certain amount of income. That income could actually come from your IRA as well. So you have to be aware of sort of the tax consequences that might be there when you're getting your private health insurance. And then at age 65, you're looking at Medicare, but you may want a Medigap plan as well. So to cover some of the gaps that you have in Medicare, what's that going to cost? So, getting a handle on these things. Right now, the average healthcare cost for people in retirement is the average is about $5,600 a year. But that's the average. And depending on what your health situation is or how what kind of insurance you want, that could be much higher as well. So you're really going to want to get a handle on that. And then there's long-term care. So there's the health care that you have throughout most of your retirement. And then you really have to factor in what happens generally towards the end of life if you're in a situation where you need to have in-home health care, or you need to be in a facility that can facilitate your health care. Cost of that right now, average in the United States, is $56,000 with 5% inflation at least. So those long-term healthcare costs are going to add up, and they need to be part of your initial plan for the back end. And so whether it's you're looking at insurance for that, whether you have the resources to self-insure, or looking at some of the other resources out there, you're just going to want to get a sense of what those costs may be down the line. And then I think the last two kind of go together, right? It's food and leisure. And the reason food is so high on this is, funny enough, but it really makes sense. They say when you're in retirement, every day is a Saturday, right? So what happens on Saturday? You might go out to dinner, you might have a couple of drinks. Your food costs tend to go up a bit when you get into retirement. And a lot of that has to do with the fact that you're going out to dinner more and you're just going out and enjoying your retirement, which goes right along with leisure, right? Your activities. Are you taking cruises? Are you taking more vacations? Are you finally getting to do some of these bucket list items and hobbies that you've always wanted to do? There tends to be a little bit of a increased cost that sort of goes against sort of the cost that you've had in working. So, we tend to see costs are we start with about 80% of what your pre-retirement living expenses are in total. But you'll see a larger proportion of your spending on leisure activities and going out to dinner than you did have before. So it's just something to keep in consideration. So once you get a handle on those expenses, now you can start to look at what your income sources are. So let's take a look at that. So I like to break this down into guaranteed income and then your non-guaranteed income. And I like to pair these sources of income with certain kinds of expenses. So I look at sort of the things that are absolutely necessary. So your housing, utilities, having a car, these kinds of things. I like to pair those with your guaranteed income. And so the sources for that might be Social Security, or a pension if it's available. Increasingly, people don't have access to pensions. And so, if you have one and you're fortunate, that's great. You can pair that with Social Security. Um, some people either have annuities or are interested in purchasing annuities as sort of a way of insuring, right? And you're paying for that insurance. So there is, you are paying a premium to be able to have access to secure funding through your retirement. And so some people might get an annuity that sort of covers any gaps they have in sort of those expenses that are those non-discretionary expenses, the ones that you don't really have much control over. And then sometimes you'll see for people in certain situations that a reverse mortgage can be used, usually later on in retirement, if you're seeing that funds aren't necessarily there to cover you towards the end. And also you'll see reverse mortgages used in some instances to fund those long-term healthcare costs that may come up. But that's really kind of situational. I think in most cases, I don't like to rely on a reverse mortgage because you don't really know what your home is going to be worth down the line and what that equity is going to be. But it is there, and it is something that you can tap into if needed. And then when we talk about the non-guaranteed income, those are your 401k, 403b, 457s, your TSP, any IRAs that you have, both Roth and traditional, and stocks, and then other, cryptocurrency, some real estate investments, things like that. So, that non-guaranteed income, the way I like to start looking at your retirement is saying, okay, so what are the non-discretionary expenses, the ones that have to be paid? And try to pair that number with your guaranteed income source. And so if you have guaranteed income that's going to cover all of that, great. Then we look at that sort of non-guaranteed, the sort of market-based income sources to fund your leisure activities, the fun things, the discretionary things that are really that are sort of the heart of a satisfying retirement. But in a lot of cases, we find that the guaranteed income doesn't necessarily cover all of those costs of the non-discretionary expenses. So that's where we start factoring in, okay, how much of this non-guaranteed income are we going to need to cover the difference? And then what are the discretionary? What are these bucket list items? What are they going to cost? What are the anticipated costs of these things? And does it make sense? And so how do we look at that? We don't know how much the markets are going to give us over time, but we can estimate based on what's happened in the past. And so one school of thought out there, it's a rule of thumb that maybe you can start with. It's really imperfect, but I'll give you a sense of it, and they call it the 4% rule. And it's basically based on research that was done in 1994 that they looked at the worst 30 years in the market. And if you had, during those 30 years, invested in a 60% equity, 40% bond portfolio, you could safely take out 4% of your nest egg in order to safely go 30 years into your retirement. So someone at 65 years old would be able to last until 95 years old on 4%. So it is a rule of thumb, and it's a way that you can start. And so you can turn around and say, okay, what are my those fixed expenses that I have versus the guaranteed income? Look at what the gap is, and then say, okay, how much do I need to generate per year? And also with that 4% rule, you can each year increase that 4% by the rate of inflation. So you are able to inflate the amount of money that you're taking out. So you can take that 4% rule and then come up with a general idea of how much of your nest egg you can be spending, and then sort of tailor that to what your anticipated expenses are. So it may be that, hey, there's plenty of money to do everything that you want. Sometimes there's even situations where, actually quite often, where there's what you expected to be spending, there's actually more money available. And so you can look at either taking more vacations or doing more bucket list items, or you can be looking at leaving a legacy for family, children, grandchildren, that kind of thing. But let me just tell you a little bit about where the 4% rule has its limitations, and it really needs to be factored in. That's why it's a real general rule of thumb, but it's a place that you can start. This was done based on a 60%, 40%, 60% equity, 40% bond portfolio. It didn't take into consideration taxes. So, for instance, if the majority of the money that you have available in sort of market funding is in an IRA or a 401k, that money is going to be taxed at income rates. And so you have to sort of strip out what it is that you're going to be intending to pay in taxes and know that that's the money that you have left over for that 4%. So, 4% in that case could end up looking like 6%. So you're really going to have to figure out where the money is coming from a tax perspective. It's also, we've looked at some of the returns on bonds over the last 10 years, and some people that have done some research have said, hey, that 4% may be too aggressive in certain situations, and said, hey, we might want to look at 3%. So it really, I go back to this idea that you have to be flexible. So you could start with 4% and say, hey, how does this look? How does my spending look? Am I spending as I anticipated? Am I spending more? Are the markets sort of cooperating in the way that we would like them to be? Or does it make sense for us to scale back on our spending a little bit in a down market, and then we can increase a bit in a market that's moving up? We call that guardrails, and that's for another conversation. But I think you get the point here. It's the formula itself is fairly simple. Just look at how long you expect to live. And by the way, there's a great website for that. It's called livingto100.com, and it's the number's 100 in that. Livingto100.com, and you can go there, and there's a longevity calculator. It takes about 10 minutes, and they ask a few health questions, but it'll give you a fairly good sense of how long you can be expected to be around, and that might be a good place for you to start. Go through your expenses like we discussed, separating them into your sort of fixed expenses and your discretionary expenses. Look at what your income sources are. Try to match those income sources with those stable income with the expenses that are most important, and then tailoring the market-based resources with the expenses that are going to be discretionary that you have a lot of control over. And then looking at maybe that 4% rule as a starting point, but really trying to nail that down as much as you can each year to see if that 4% rule is actually making sense in your life. So just a place to start on how and when you can retire. I hope this is something that's been helpful for you. Please subscribe to our channel if you want to see more of these videos, and thank you very much for listening.